to all the viewers who have joined in, and to the panelists, to a very insightful episode of the Brand Horizon Bespoke Show. The topic that we have picked for today is enterprise risk management. Why this topic? Well, no business is devoid of risks, be it a large enterprise or an MSME. And two, the current environment has brought with it risks beyond traditional risk of loss to physical assets and financial risks. So for one, we are in an age of global environment and social media, which is a double-edged sword. So just as an example, one negative comment from a customer on social media could go viral, and it could magnify into loss of business reputation and shareholder value. So those are the kind of risks that we are talking of, point number one. And point number two, there's also what we call as the new age risks, such as risks emanating from Industry 4, the cybersecurity risks, and so on. And three, if we do not have a strategic vision and prepare ourselves for contingencies such as the pandemic, which is a very classic example, we could be having a huge disruption in our businesses. Of course, alongside goes the traditional business risks, as we all know from the Porter's 5 forces. So under these circumstances, we felt this was a topic that could be of high relevance today. And all of these makes risks management an integrated process rather than a standalone function. And it demands and deserves a buy-in from the topmost level at a board level to make sure that there is an ERM framework in place, which is very agile and keeps evolving. And the ERM team takes care of risk factors, not just the leading ones, but not just the lagging risk factors, but also the leading risk factors, by which I mean both the current and future risks. And to discuss all of these today, I'm privileged to have a very distinguished panel who have several years of domain expertise in enterprise risk management, cutting across sectors, cutting across geographical boundaries. We're looking forward to hearing insights from our esteemed panelists on their own experiences and real life stories on how they went about managing risks during their professional journeys. But before that, let me first introduce the panelists. Our first panelist is Keerthana Mainkar. She's an AVP and Group Manager heading Enterprise Risk Management Function for Infosys Group companies. She's a chartered accountant by profession with more than 23 years of experience spanning design and implementation of ERM framework. Prior to her 17+ year stint with Infosys, she has led risk management reviews for many of PwC's top 50 clients as part of PwC India Operational Risks Management Team. She has conducted several global workshops and spoken in multiple conferences. She's currently representing Indian BIS in ISO 31000 Technical 262 Committee. She's on the RIMS India Advisory Board, Asia Pacific Regional Advisory Board, and is the Vice Chair of RIMS India Chapter. Privileged to have you, Keerthana. Thank you for joining.
Thank you, Asha. Thanks for having me.
Our next panelist is Raj Gandhi. He's the founder of GGV London. He has over 25 years of experience and has held board positions specializing in finance, treasury, governance, and risk within the financial, energy, and retail sectors. He is a consultant, mentor, and a course leader for the last 10 years, working with prominent institutions like ACCA, ACT, Euromoney, ICA, EW, and the Institute of Directors. Privileged to have you, Raj. Thank you for joining.
Thank you, Asha. Pleasure.
Our third panelist for today is Ramraj Vupattur. He is Director, Global Risk Management at Oracle. He is engaged in conducting project health checks globally as part of risk management. In this role, he has built a strong sense of risk management activities about how project risks are identified and mitigated by being fully involved at every stage of the software sales cycle. An IT professional with an overall experience of 17 plus years, he has been engaged in several roles as part of BFSI vertical, such as project management, delivery, risk, and compliance. He has worked in several multinational banks globally and possesses a strong multicultural and business development experience and has interacted with CXOs of banks in Asia, Europe, North America, Latin America, and the Caribbean. Truly a privilege to have you, Ram. Thank you
very much. Thank you, Asha.
Let me move on to my questions, and I would like to pose the first question as a common question to all the panelists. And I would like to start this with Kirtana, followed by Raj, and then with Ram. The role of an ERM head is a very niche role for two reasons. One, because organization has to be looking at not just current risks, but also potential risks. And two, it's a very integrated function and not a standalone.
Yeah.
So given these two challenges, I would like to hear from you how you have gone about framing an ERM policy in your organization and what are the challenges you have faced in the process. Kirtana, over to you.
Yeah. Thanks, Asha. I think it's a very, very interesting question, something which is very close to my heart. ERM is no more just a controlling function. What I have seen in my experience in my organization or with my professional friends in some of the forums that I'm involved in, ERM is really evolving as a decision enabler or a decision support system in the organizations. But how do we do it? How do we keep the ERM process current, relevant for the organization? How does it keep evolving? How do we make ERM a pull versus a push? This is something which we also grappled with about 5 years back when we started our process of reviewing the ERM. Of course, in my organization, we have had ERM as a separate function, as a separate process, long back from almost 2006 onwards, right? But however, we felt the need to re-look at the way we had done ERM, and that is something which we started about 5 years back. When we started our journey, we looked at various organizations and we said typical ERM functions are of three types. Either it is controlling or compliance enabled or as an enabler function. Controlling is where ERM becomes a check gate for any decision that is being taken. Unless it is approved by the risk head, you don't go ahead, right? You don't invest any money. While that is good, the negative side of it is ERM is viewed in a very negative way, right? So they tend to have the control or the power. The other form is the compliance function, which is more a tick box, right? We have to do it, so we are doing it. So we have to have a CRO, so we are doing it. We have to have a board risk committee, so we have it. And this committee needs to meet twice a year, so we are doing it, right? It's more a tick box and it's driven by the compliance function. But the third is where it becomes an enabler function, which is where ERM truly acts as a decision support system. And this is where you don't look at the strategy and pick holes, right? You think from the perspective of how can I make my strategy work? What are the challenges to my strategy? What should I look at? How can I overcome those challenges to the strategy so that organization as a whole achieves its objectives. That's one. Second is also to say, is my strategy current, relevant? Am I looking at the future? Because ERM, as you rightly said, it's not about the current risk. You also need to look at what's going to happen 3 years down the lane, 5 years down the lane, whether I'm prepared, right? Being a technology company, are we looking into the future? Are we investing enough in R&D, right? Are we identifying the technologies, tools, platforms in which we need to invest? That aspect also comes in, right? So achieving the strategic objective as well as keeping the strategy current, something which an ERM team will have to look at, risk office will have to look at. That's how you will make ERM a live process, right? So it continuously evolves as the situation changes, and as the risk to the strategy change, or as the strategy change, or as and when the market environments change, you have to evolve your strategy. So, I truly believe in this statement that risk and strategy are two sides of the same coin. So that's how it all comes together. And to your other point on, this is a cross-functional piece. This is, ERM is not it cannot work in silos. I completely agree with that, because ERM is just a facilitator to the process. Risk head or chief risk officer does not own any of the risk. We are just a facilitators, and it's the business which owns the risk. So they need to come together. And several times business leaders also do not have all solutions. Solutions lie with different departments. So ERM works like a glue, bringing everybody together to the table and looks for the solution. Based on the data, it enables the executive leadership to take quicker decisions. So, it's truly a cross-functional work. And by linking into strategy, we can keep the entire ERM process live, current, and relevant to the organization.
Thank you, Kirtana. Did you face any major challenges as you were going through this journey?
See, there are challenges in, I would say, you can also link it back to risk culture, right? The biggest issue when you roll out this kind of an ERM is, first of all, in ERM, as the risk office, we do not own the risk, as I said. So we need the business owners to come up and speak about their challenges. When that happens, there are typically a few issues, right? First and the foremost is, why should I do it? What's in it for me, right? Are you just adding to my operational work? Are you asking me to do more and more documentation? I'm already overburdened, right? So what's in it for me is a key question that we from risk office will have to answer. So once that is done, the other key aspect is, why should I be the negative messenger, right? As a business leader, should I put forth the risk? Let it bubble up on its own. And if I put forth a negative point, will there be any reaction to that? Will there be any punitive action or anything? How comfortable am I putting forward a negative issue? Or is there any fear of being singled out for being the negative messenger, right? And it's okay, I will come, I'll tell you what are my risks. Then what, right? Are the decisions going to be taken faster? What's the use, right? This is another issue that we really had to grapple with, right? And there is no place or forum where people can come and talk freely about all the negative issues. I'm talking about all these challenges, Asha. This is not just to my unique to my organization, but I've seen it in many of the organizations. This is a common problem, when we try to roll out ERM, right? So there is no common forum or place where risks or challenges are openly discussed, appreciated, right? So that's another key issue, right? And then business owners, they need to own the risk, right? So you cannot pass the buck and expect somebody else to do risk management for you. It's your baby, right? So you have to do it. So they need to get that sense, right? And the last one, which I have seen, is particularly from the leadership side, which I have seen in many of the Indian organizations. If we introduce risk management, and if we allow people to talk about the issues and challenges, it should not be taken as an insurance by the business leaders, right? So You can't say, oh, look, I highlighted the risk, and because of the risks or challenges that I face, I could not achieve my target. I mean, you don't take it as an insurance. That's a bit of concern that I have seen in many of the organizations, which the leaders actually feel. If we allow someone to come and talk about the challenges, then they might take it as an excuse for not doing what they're supposed to do. Right? So all of this needs to be handled in a different way, right? So that's where I think the culture plays an important role. We'll have to get the leadership, the tone at the top is very important. They need to understand. And then a lot depends on how risk office works with the leadership to say, look, people are bringing up issues, so we need quicker decision making. Right. So that's another aspect. And also to explain to the business leaders, look, if you bring up the issues, you will not be singled out, but you will get better response, you will get resolutions or solutions to your problems, so you can move ahead and achieve your objective. I think all these, right from board to the business leaders, risk management plays a key role in getting everybody to the table to understand and appreciate risk. Once that is done, I think ERM becomes a pull and it's not a push anymore. So that's what we need with multiple organizations.
Thank you, Kirtana. I really love that sense of creating a pull instead of a push culture that kind of brings in ownership, and then it makes the senior management team's job much easier. So it's the initial build-up of the culture, and then it's kind of setting things on an autopilot.
Yeah.
Thanks for your insights. Raj, can we move on to you? You've been doing a lot of consulting roles, and I'm sure you would have come across various aspects of creating an ERM framework, and you would have owned it on behalf of the client. So would you please share some of the key aspects that you had to go through as milestones through the journey, and what kind of challenges you faced?
Yeah, thank you, Asha. Yeah, this is a fascinating, challenging subject area, and I draw on my experience in the boardroom working for some large companies and some multinationals over the years. And particularly in the last 10 years, I've been training people around the globe, and some 200 directors each year. And when I reflect on that, there is a theme that is appearing. So what I'm finding is that people don't really understand risk. That's the issue here. And so I think boardrooms, and I'm talking in generality, need to embrace what risk is all about. And when you really distill it down to a couple of things, it's about preserving the enterprise value and growing it. That's what risk management is all about. So then how do you manage this? Well, you can have people like chief risk officers if you're big enough, or you may have compliance teams or finance teams who can try and look after risk. But the problem here is that that's all they can do. They can educate and they can bring in processes, but they can't make decisions, you see. So you need the tone at the top, which Kirtana very rightly touched on. So what I'm finding is that before we embark on rolling out an ERM across the organization, one needs to have a bit of a pyramid structure. And the pyramid starts with the boardroom, which says, well, let's talk about good risk opportunities and let's talk about bad risks. And if we can learn about those two things and try and make sure that it's about preserving enterprise value, then let's look at opportunities which give us compensation in taking that risk. And let's look at the bad side of risks and let's make sure it doesn't destroy value. Once the boardroom is decided on the risk appetite at the top of the pyramid, then it can distill it downwards. So now we talk about getting the right people in to cascade this mantra, if you like. And so the concept of decentralized or centralized risk management comes in. So if you're a very large multinational or a company that's trading cross-border, then you want to think about giving empowerment to units overseas perhaps. And so now we talk about the risk owners and risk champions. Now this whole thing isn't going to work unless there's a buy-in at the lower levels. And the lower levels are looking for the higher levels to set out what is acceptable and what's not acceptable. So now you get maybe risk champions, subject matter experts, you get chief risk officers, and they will say, yeah, sure, we can come and raise awareness. So the concept of awareness training comes in. So it's pointless having a unit saying, well, look, you're responsible for risk, when they don't really understand what risk is. So then you talk about risk. There's no risk if there's no objective. And there's no objective if there's no strategy. So you see, there is a very strong link between having a very clear, tangible strategy and what are the underlying risks. And to just kind of finish off on that story, then you need to almost create 3 buckets of risk. People focus far too much on financial risk. But look, you know, there are much more to a business than just financial. In fact, most people don't quite get what financial risks are. They talk about interest rate, currency, great. What about commodity prices? You know, in a global situation, we need to be very clear on the price of oil or whatever it is. That's a financial risk bucket. Then you've got the business bucket, which is really, what's my business model? Or what's my margins? Which geography am I trading in? And then you've got the third bucket, which is the operational risk. So we now think about systems, fraud, you know, stuff like that. But then you've got cyber risk, which actually starts its origins in operational risk, but cuts across all of them to business risk. So I think this is an incredibly specialist areas, and I think boardrooms are just waking up to the fact that they need to think about risk in everything they do. And strategies out there are very much often not well written, not executable, and don't pay attention to risk. So I think ERM is taking a new meaning now. It's not about risk maturity, it's about risk awareness and focusing on priority risk. There's a lot of things that and this is what I'm mentoring, if you like, boardroom directors who come to me and say, risk is bad. Well, it's not bad, it can be good as well. So quite a few things going on here, and you can see that what Kirtana said and what I'm saying is not too dissimilar. All I'm saying is there needs to be an underpinning, which is the tone from the top, at the top. That's what I'm saying. So we're broadly in agreement for sure.
Thanks, Raj. That was a nice summary. When you say there has to be a buy-in from the risk owners at the lower levels, to what extent do you think they should be involved in defining the risk appetite that the organization should be taking? Or is there something that should get decided at a board level?
Now that's a great question. Let's just touch on what risk appetite could look like. There is a financial qualitative perspective, or there's a quantitative perspective. Give you an example. A quantitative might be that we want to maintain a certain credit rating, or it might be we must have a certain headroom in our cash facilities, borrowing facilities. And on a qualitative side, if you're a financial services player, you might say, I don't want to have any breaches of regulation, zero tolerance to that. So you see, the boardroom has to set out what it can accept and not accept. It's then up to the risk owner or the unit or the department or the subsidiary to say, okay, we've got a very good sense of high level acceptance to tolerance. This is what we can do. And now the conversation starts. So it's from top down and then bottom up. And it's quite likely that the top management may not see something that the experts have picked out at the bottom. Or it is quite likely that the bottom side, the operators may have misinterpreted something and there is a need for some discussion. So this is where you need what we call business partners. Now, you may have heard of the concept finance business partnering or HR business partnering or treasury business partnering. These aren't rocket science, but they're essentially getting people out of their back offices and communicating with each other. And what I'm finding is that the CFO is taking a leadership role in pushing back on strategy, on risk appetite, and then taking what's defined and then taking it to the middle managers and operation and just making sure they get it right and having a pushback session with them until such time that there is agreement. Right. And then agreement leads you to buy in, you see. So it's a two-way process, which can take a lot of time, but it's well worth investing time and money in that because it saves you issues further down the line.
Thank you, Raj. That was insightful. Moving on to Ram. Ram, you own global responsibility at Oracle for risk management. So I can imagine the kind of cultural challenges that may add on to what a national head would have or an Asia Pacific head would have. So it'll be interesting to hear from you how you go about establishing a receptive and effective framework, and what are the kind of challenges that you have faced and overcome.
Right. Thanks, Asha. Am I audible? I think there's a lot of background noise, right?
No, you are audible.
Okay. So I think Kirtana and Raj have, started off and explained how risk management evolves. So what happened, within our organization about 15 years ago when, Oracle had acquired iFlix Solutions, the basic risk management as a team was not in place. So Oracle, as the bigger organization and many acquisitions, they brought in a lot of tools for risk management. And we thought it was the right time for us to establish an enterprise risk management committee and a team. And that's when risk management was even established in Oracle Financial Services. So I was privileged to be part of that group for the last 15 years now. So what had happened was, as rightly mentioned by Raj, we had to get an acceptance from the boardroom, right? So all the leaders of each of these divisions, we had to bring in some confidence and, let them know that risk management is something that you're not spending time or, it's not a barrier. It's not a Great Wall of China where, you will have to understand the nuances of what exactly goes into risk management. So there were a lot of tools, there were a lot of training given to each of these leaders. And once the acceptance from leaders was received, then it was easier for us to bring it down to the the rest of the folks in the organization. Now, what we did was there were a lot of trainings, external trainings, internal trainings given to all of these people. And slowly, after the acceptance was received, we started moving towards how risk management can be, used in our day-to-day operations. So what we did was we started getting into contract reviews. We started getting into how we estimate. We started getting into financial management. And of course, each of the other parameters would be, your resourcing, your governance structure and things like that. So each of that came into existence, and then we slowly moved towards the customers. Now, customers are not really worried as to what you're going to do because they expect you to be risk compliant in each of your activities, in your deliverables, in your governance structure, etc. So what that was when we brought in something called as the health checks. So what a health check means is, every project at a regular interval, we visit the senior management of all the financial, the banks in the financial industry. We tell them that, this is not a paid activity where Oracle is investing and getting this done, right? So we seek their advice, we seek their opinion, we seek their inputs as to how we could improve on our delivery and what are the risks that they foresee in a project, because each project has its own challenges, each project has its own duration. So that's when, the customers also started understanding what the project health check would mean, because they will have to spend time with us. So it's like, each of these sponsors from the customer side will have to spend at least about 45-50 minutes each, right? So that became very popular within the Oracle world. Customers started encouraging us to do this quite often. Initially it was a barrier. They said, no, we do not have time to waste. Why would I even invest so much of time and spending time for your internal reviews? This is something you will have to do. But then, without getting the customer's opinion, without understanding what the challenges are, without understanding what the risks the customer would foresee in a project, it's difficult for us to do it, right? So we are good compliance within the organization. So that became very popular. And now, regularly for all the large engagements that we have in Oracle, we get into the risk management. Now, coming to the internal reviews, there was a point that Raj brought in where he mentioned about qualitative risk analysis and quantitative risk analysis. So we do this exercise very frequently as soon as a contract is honored, right? So what we do for larger engagements, we do something called as the quantitative risk analysis, and for smaller projects, we do a qualitative risk analysis. That again helps delivery to understand and quantify the risks in their project even before the project starts. So they're ready with their. Can you all hear me? I thought
we lost you in a little bit in between.
Oh yeah, okay. There was no movement, so I thought I was just still.
Please go ahead.
Okay. So the project owners, the project manager and his subordinates, they understand, and we allow them to brainstorm and understand what exactly they would need to understand based on the contract they have in hand today, before even they go into the execution part. So this is a 3-day workshop that we conduct, and at the end of the workshop, what we do is we prepare the risk log, right? And that the risk log would contain all aspects of your risk management, right? From your financial management, your resourcing, your qualitative and quantitative factors, various other parameters. So that becomes a ready reckoner for the project teams to start their work with, right? So tomorrow they don't have to sit during the project execution, because we have a very tight schedule for each of these engagements. So they don't have to reinvest all of these all over again. It's a ready reckoner handed over to the project team, where they will have to find a risk owner, they will have to do the mitigation, and they will have to start informing the management on how each of these risks have been identified and mitigated. So those are few of the tools, but yes, I'm sure each of the organizations have our own internal tools that we use on a daily basis for risk management.
Very interesting, Ramraj. I think I like the kind of framework that you mentioned about making cross-functional teams for review of projects. And yes, I think that brings in a lot of ownership and involvement into the process. That was one. I would like to also get your insights on 2 points. Point number one, something related to what Raj was mentioning about the involvement of a CFO. Because I have a perspective, although I'm a finance person myself, I have this apprehension that CFOs can tend to be overcautious and overlook potential loss of business by being overcautious at times. So I would like to pick your brain on that point. To what extent a CFO should get involved in this whole process, or he is one member of the team, just like any other member, without a specific emphatic role. That's one thing. And second thing is, I would like to know if you faced any cultural challenges, because you've been handling global risk management, and I'm sure it comes with huge, what shall I say, differences in the way you have to handle this whole process.
Yes. So let me start with the acceptance from the CFO's office, right? So all said and done, end of the day, there are 2 points that all of us will have to bear in mind. One is the profitability, and one is the brand value and shareholders value as well. So risk management, end of the day, comes down to how you could save costs, right, and how you could save your image in the market. That's all it matters. Now, what we do is, again, we have a tool. I will not be going too detail into it. So every project will have to undergo this entire gamut of documents that we have internally, even before it reaches the customer for a signature. So that goes into several checks within the organization. And the very first check would be the risk management team. So we do the entire scrutiny of the documents, including the financial management as well. And that will have to be signed off by your tier approvals, that is the management level. That could even be the CFO and the CEO office. Without they signing off, none of the contracts are even submitted to the customer. So it all starts with risk management. Now, what we do is, at least to give the confidence to the CFO's office, what we do is at regular intervals, end of the month, we submit a report to them saying that, this is where we were in a particular project and how risk management has helped the project to kind of, come up to the curve in terms of improving the margins and not going below the baseline margin. And we also involve ourselves in the forecasting for each of these projects. So that has given, the management confidence in what a risk office is all about. So that is from an internal organization standpoint. Now, going back to the cultural differences within the regions, that used to be a major challenge. Fought it over, but today I think every customer understands what the risk management role is all about, and they encourage us to involve every stakeholder of the bank or the customer to be part of our risk team, to engage themselves in reviewing each of these risks on a daily basis. Now, there are certain customers who are very sensitive because the moment you say risk management, they feel we are auditors. We are definitely not auditors. So nowhere, when we meet the customers, we do not call ourselves auditors. The moment you say auditors, they just go into their shell. Right. I mean, that's not what we want.
They don't open up.
Yeah, we want them to open up. Otherwise, it's never going to help any of us. I mean, ultimately, the success story comes in only when we have, acceptance from the customer as well as the support from the internal teams. So audit is something which is too far away from risk management. We don't use the language of an auditor. So that took a lot of time. So people, thought we were just trying to go in a different form, but still being an auditor inside, right? So we kind of gave in that confidence to them. Of course, we do not share any of our internal reports to the customer. We set the expectation even before we meet the customer, saying that this is something Oracle is investing. We are not, to do the project health checks or to do the risk management workshops. These are all invested by Oracle for the benefit of our customers. So today, it's become quite common. So, every customer wants us to get into these exercises on a regular interval.
Yeah, I'm sure the customers will see value out of this, even from their own perspective in terms of delivery and in terms of quality. So I guess it's the initial teething problem, and then right. It's easy for getting the customers buying into it.
That's
Thank you, Ram. Very exciting, very interesting insights. There were, without mentioning the names, there have been a lot of there are a lot of instances in corporate legacy where risks that were identified as low probability. I mean, in ERM, we all know that we identify risk factors as low probability, moderate, and high. So there are several instances where it has been wrongly evaluated as a low probability, and that has gone on to result in corporate collapses. So identifying the right level of risks is also key in risk management. Are there any instances that any of you would like to share as a real case study that you have come across or that you have been party to in terms of how lack of an effective ERM has resulted in corporates suffering big damages? Maybe I can start with Raj this time. You are on mute.
Yeah. So if we look back to the past couple of decades, are we hearing some noise in the background? I'm wondering if it's my
request everyone in the audience to put themselves on mute. Only the ones who are talking can.
So yeah, that's better, I think. Okay, so that's a great question, and I think corporates and governments as well have a lot to learn from past failures. So when we look at let's say the last couple of decades, then there are a lot of high-profile collapses across the globe in corporate land, if you like. So when we think about what are the reasons why some corporates have collapsed, then you could say that they haven't been agile enough. Maybe new technology has come in and they didn't see it coming, or they were just oblivious to them. They just felt that they had a very good marketplace and customer base, and that will continue forever. And then we've had the digitization, we've had the real-time hunger for information. We've got customers who want to go shopping online, and there's so much going on. And the pandemic has, if anything, just sped up that time curve. And yet you see some organizations who've just not been willing to change. So it comes down to the strategy. And the strategy says, here's our business model. And it's well-founded. It's got historical success. And so we should continue with it. But actually, you can roll out a business model in different ways. You know, a supermarket chain can think about going online during pandemic, and suddenly they'll find they have less strain on their cash and more chance of sustainability and survival. So what I'm saying here effectively, Asha, is that when you go back to all the corporate disasters, it's basically leadership teams have not been fast enough to see things coming. And that's because their risk maturity hasn't been there. And so their strategy is all about delivering on the past when it requires what are the opportunities, what are the threats, and are we in control of them? So most organizations, to my experience, fail on two accounts. One is they write out strategic missions or visions which are full of vacuous promises. They can't deliver, they can't measure. And secondly, they don't have risk attached to it. And therefore, when bad things come along, they're ill prepared. So I think that's a problem of leadership. And then the other problem is awareness of risk across the organization. So if I'm a managing director of a very prominent subsidiary and I've never thought about risk, then I'm not going to suddenly think about it because I don't know how to think about it. So when we try and say, well, okay, that's the issue, what's the fix? Well, this is what I see as a fix, that each time, and Ram touched on this a little bit, each time a project is put forward, the boardroom should expect to see, why is it a good thing? What's the good risk, bad risk? And how does it align with strategic imperative? And if I don't see those two things in any board papers coming to me, then I'm more likely to just put it aside. And now that forces education and awareness on the sponsor of the project who has to do those things. And I'm talking risk at tactical level, at managerial level, at strategic level. And all of this is all part of the whole risk proposition. So I've given you sort of a slightly in the clouds response, but I think you'll see there's real merit in what I'm saying here, structural merit. You're on mute, Asha.
Thank you. It's a lot of the strategic gap that could lead to an effective ERM. I could sense that. Kirtana, do you have any experiences that you'd like to share in terms of like a case study that you want to summarize?
Well, Asha, I think before I go into case study, I mean, there are many of them which are available on the web itself. Rather than going into specific case study, I want to touch upon points, just elaborating on what Raj said. Typically in ERM, you have different phrases, like white swans, black swans, and gray rhinos. And now I've been hearing black elephant also. People tend to mix up gray rhinos and black elephants. Most of the organizations tend to focus on white swans, right? White swans are those, the typical small risk which keep materializing where the probability of occurrence is very high, but the impact is not that high. Right, so we just keep looking at those and responding to them, and we think that we are doing good risk management. And black swans, it just comes and hits you. You can't, it's like the current pandemic situation. No matter whatever you do, right? Typical BCPs, if you see, they are focused on individual regions. Perhaps nobody would have thought about the entire world, structure collapsing like this, right? I mean, it's almost like a doomsday scenario, which usually organizations don't get to do it, right? So your preparation for black swan is what kind of agility you have, how quickly, how well you are able to respond. That is what matured organizations do focus on, because you can't imagine and predict a black swan event. I mean, that's why it's called black swan, right? But the most important thing is the gray rhino, in my opinion, or the black elephant. It's, depends on which author you are referring to, so it is interchangeable. Right? So I think Thomas Friedman calls it as black elephant and Michelle Hooker calls it as gray rhino. So these are the risks which are low probability, high impact risks, which can happen, which is staring at you, which is there, but you do not respond to it either because you don't think it's going to materialize, or your organization is immune, you're in the best possible secured place that you're not going to get impacted, or you deprioritize responding to that risk for various reasons. It could be cost pressure, it could be, because of course resources are limited and you have to decide where you're going to channelize your resources. I mean, this is what I believe, in my understanding of several case studies that I have seen, where the change is happening. We are not quick and agile in responding to the change. We are not adapting ourselves. We are not reinventing ourselves. And that ultimately leads to the collapse of the organization. It's these gray rhinos which come and hit us. Gray rhinos which have hit many of the large organizations, be it the world famous the mobile phone maker, or the camera roll manufacturing company, or the original smartphone from Canada, whatever. I don't want to get into the names, but any of these companies, if you see, it's the lack of agility to respond to a gray rhino. I think it's that's probably has what is left. You can do a lot of dissection and bisection and say, okay, at a point of time they had leadership change, they did not respond, there was a competitor who came up with an innovative product or whatever, right? There can be n number of reasons, but it's the adaptability and keeping an eye on the future strategic change, right? So that is the risk that you have to manage. Today, it's not survival of fittest, it's survival of adaptable, right? One who is able to adapt and change is the one who's going to survive. I think that's where they didn't do proper risk management, and that's probably led to the collapse, right? So that's the way I would look at this.
Very interesting examples. Kirtana loved that and loved those names as well. I think it's the inability to envision the future, and somewhere I think Porter's 5 forces was not really taken seriously, and that's what led to where they are. So leaving it there, moving on to Ram. Are there any specific learnings from real life cases that you'd like to share, Ram?
Yeah, sure. I mean, it's definitely not a case study per se, but what we've heard from our experiences and what has happened in the competitors' world, right? So, risk management, again, end of the day, it's profitability, your financial status, your stakeholder importance and things like that. So in one of the cases, what happened to the huge collapse of the entire engagement was the fact that planning was not in place. They were just chasing for the 30 million or $40 million contract, but the contract was signed, and how are you going to even execute? So they were not prepared for it. Now that is where we as risk management team, we have to be there to help them understand what are the risks in the project. So in this particular project, the risk was to do with the resourcing itself and mobility. So when we say mobility and risk, how are we going to ensure we have our work permits in place, right? So that was the least of the importance that an organization gave at that point in time, because they were just running behind the numbers that they were seeing on the screens. So the contract was honored, and it was time for us to onboard the resources. And then there came a big bang. They said resources. Let's say there were about 100 resources we had to onboard. But that particular country had a restriction on the resources from an organization that can be onboarded to the customer side, which was not expected at all. So this amount of work was not done by the organization earlier, even before the contract was signed. So in a place where 100 resources were to be onboarded, there were hardly about 25, 30 resources. So how do we even execute the project? Right? So these are the small things, and most important ones are the ones where the sales teams, we've seen that happen many a times. They go, they show the the moon and the stars to the customers, but that's not the fact. The business teams will have to be aware as to what was actually shown to the customer, because end of the day, the business is what matters. There have been a lot of failures, where the coordination between the sales team and the consulting folks were not there, right? So yeah, so these were few things, a few of the examples I could give, real life examples where the contract was cancelled. It was probably about $30-40 million contract, and we had to scrap the contract and then revisit on how we could do an offshore and on-site model. And today, like Kirtana was saying, this is a very good example during the COVID times when people are not able to travel for executing the project. How are we going to manage, right? So, which was not thought about earlier. We were just, as and when there were resource crunch, we used to send people. People used to come back for personal reasons. But today, it's just a standstill. So this is where we've gone back to our customers. We've set expectations. We've kind of changed a bit of a language in our contracts. We've bought in the offshore on-site model where we recruit local resources, and then from the Indian-based resources, people work from their home base. So yeah, I think the pandemic did teach us a lot in terms of how you could better manage projects. So yeah, I think that's an ongoing cycle.
Yeah, great insights. I think the pandemic also has brought with it a lot of qualitative risks, right, Ram, in terms of the fatigue from technology and the psychological risks involved in terms of insecurities and man is a social animal, so not being able to socialize with the team, so that's resulting in loss of productivity. So do you see these challenges happening also in your organization? And are you
most importantly, I would say maintaining the relationship with the customer, right? So today's relationship is only through Zoom, right? And which is a new culture. Whereas in the normal way of life, it used to be sitting across the table with the customer. So the customer is more confident on you. The customer is more confident on your services. But today, things have changed. So that's a huge risk in a brand reputation, in maintaining a good collaboration and relationship with the customer.
right?
Yeah, I mean, Asha, if I may add.
Please.
Yeah, so pandemic, I would say initial stages, it was more operational because we had to get the infrastructure going, move the laptops and desktops to homes of people, get everything set up, right? So I think the phase one or the initial wave last March, April, the entire focus was on getting the infrastructure up and running and getting the contracts modified so that customers would allow us to work from home and so on. But as situation progressed, now I think the entire focus, as Ram said, one is on customer relationship management, and second, which is equally important, is employee wellness, right? Employee safety and wellness management, because continued working from home, while a lot of people do appreciate working from home, but the prolonged working from home has really created fatigue, has reduced the social capital because there is no interaction. A lot of things which used to happen over water cooler chats or coffee table chats, for everything you have to pick up the phone or set up a meeting, right? And there is no line between the personal life and professional life. So there are too many things happening which are creating more and more problem, which is causing immense stress to the employees, more so for the female employees, because they have to tend to a lot of things, right? So employee wellness is a key focus area which has come up along with cybersecurity. So I would put it as cybersecurity, employee wellness are the key areas of focus in second wave. And in first wave, it was initial is, the setup, the infrastructure setup and things like that, getting the policies, getting the financial support and all those things. That's the way I would break it up.
You summarized it very well, Kirtana. Actually, you were that was going to be my next question in terms of how it has impacted not just the organization but also the employees. So I think this situation really challenges leadership skills, how people can exercise their empathy and a sense of belongingness to the organization and treat them as families. So this is a true test of leadership for many organizations. And I was going to, we have another 5 to 10 minutes if we can continue. I have a couple of questions as well. Before that, I would like to ask each one of you, I think Kirtana summarized two risks that's very important. One is the employee welfare and the cyber security. So I would like to hear similar 2 or 3 risks that Ram and Raj think that organizations should be focusing on, not just for today, probably in a span of 3 years from now. It could be Industry 4 related risks. It could be the digital age risks. It could be the drones and automation, whatever. So I would like to hear that from the experts, and maybe Kirtana may want to add on more to the list. Over to you, Ram.
Well, I think cybersecurity is one major area where we are also focusing on at the moment. So, I mean, I'm sure all of us on this Zoom meeting, we're still not sure on how the days are going to be as we move forward, right? So, is work from home culture going to be the way things would look like, or we don't know? I mean, it's still a gray area. So that itself is a risk factor. What are we going to foresee in the next couple of months? Nobody knows. So what we've done, one is, as Kirtana mentioned, since last April, we started amending the contracts with the customers and letting them know that, we can still continue our business, but with a little change in the way we work in terms of a model. So the acceptance from the customer was not upfront. There were a couple of projects which are still being put on hold because customer feels, our presence in the bank in their site would always make a difference because they haven't had a prior experience in such a large engagements, in such large projects. So that was one point. Coming back to cybersecurity, I think there is the IT teams have been working on various security functions, being set up on a regular intervals. So that is something we've been noticing in the last couple of months now. So every day or maybe once a week or twice a week, there are a lot of these patches being introduced in the way we connect to the VPN and our other environments, right? We have the development environment, we have the testing environment, so on and so forth. So there are a lot of patches being introduced by our IT team as well. So I think during the pandemic days, every day seems to be a challenge. Something new has been coming up. In fact, what surprised us in one of the projects was the fact that the customer is absolutely fine in us doing an offshore kind of a delivery, but the point is, how do you engage customer stakeholders and customer users, the end users, especially in a financial sector. We want the end users to be very active in testing cases, without which we will not be able to even move forward for the production. So these are the areas where we are trying to work. As I mentioned, every day seems to be a challenge. Something new keeps coming up.
Interesting. I have quite a few questions from the audience, but before I move on to that, Raj, would you quickly like to list 3 risks that organizations should keep in mind, and feel free to cover both current risks and potential risks.
Yes, indeed. Thanks. I think when we talk about risk, there is a tendency to think one-dimensional, and of course, risks don't happen in unison. They happen with a lot of wide-ranging effects. So when we think about 3 risks here, I'll talk about business disruption, I'll talk about cyber, and I'll talk about cash and liquidity. So when we talk about business disruption, we're asking the leadership team to think about renewing that business, transforming it, sustaining it. And that means, updating the business model, looking out for geopolitical issues, cross-border trading, global matters. When we think about cyber risk, there is a tendency to think about or get confused between cyber threats and cyber risks. They're 2 very different things. As an organization, it's your job to identify what are the likely threats, and then look at which are the risks which fall out of that for your particular organization, and then prioritize it. So I think there is a tendency to get confused between the 2. And then when we talk about cash and liquidity, at the end of the day, that's the oxygen of your business. And if you run out of cash, no matter how profitable you are, you won't be around for much longer. So what I'm finding when I'm training CEOs and CFOs and treasurers, they're all saying to me, look, first thing, let me get enough money to keep going. how do I do that? And that's where we think about really very solid cash forecasting. And I don't mean accountant's cash forecast. I mean bank statement cash forecast, and doing it in short, medium, and long term. We think about refinancing it. You know, how to refinance, where are the funding sources likely to be, or if we're a cash-rich company, where do we put our money? You've got a counterparty risk. So when we think about risk, you know, do remember that there's a tsunami effect here. You know, when cyber happens, it doesn't happen on its own. It brings with it a lot of other issues. And so this is the kind of message that I'm giving out to people that I'm mentoring during the pandemic. So I hope that kind of helps a bit.
It does, sure it does. Thanks, Raj. Kirtana, any points to add on before I start taking questions from the audience?
Yeah, Asha, so I think cyber has been mentioned by everybody, so that's one. The other thing that I would say is government regulatory changes, right? So especially with this pandemic, what we are seeing is more and more governments are becoming inwardly focused. They are also seeing the challenges of being dependent on certain regions, certain geographies, extreme exposure to certain geographies, which could hurt them in the long run. So, you know, some policy change to that effect is something which we need to be watchful of. In addition to the government regulatory changes, I think I agree with Raj on the business disruption risk, which is also, you know, somewhat, because of some of these geopolitical changes that are happening, and as well as the strategic changes that may happen. Today, it's very difficult to say who's going to be our competitors in next 3 years. You know, perhaps none of the auto companies could have imagined a cab sharing company would be their competitor, because of which their sales would dip, right? So who's going to be your competitor? How will your customers react? What will be their priorities? A lot of these things do change. I think keeping an eye, close watch on these and evolving and investing in R&D or not doing it is a risk that an organization needs to be really worried about. Apart from this, social media risk is another key aspect, right? So many of the organizations which are particularly in B2C, for them, this risk is very high. A small tweet, you know, putting a negative message about a company can just go viral, and then you will be doing a lot of damage control, right? So I think that's another risk that organizations need to watch out for.
Yeah, that reminds me of an incident that FedEx handled really well. They actually put up the video of bad handling of a fragile parcel, and they used that as a training for their employees to make sure that it doesn't repeat for the future. So they made sure that the training video went more viral than the original video complaining about the bad handling, and they actually used it to their advantage. So I guess that's how social media can be used as a double-edged sword.
Yeah.
Great insights, Kirtana. Do you also see a threat from, let's say, autonomous cars? So because you were saying you need to keep an eye on the future, so maybe we need to start thinking about risks arising out of autonomous cars and cryptocurrencies, for example.
Yeah.
Organizations that are not agile enough to accept different forms of payment could just disappear from the scene, right?
Absolutely. It's, as I said, Asha, it's survival of adaptable, not survival of fittest anymore.
Right.
Yeah.
Great. I'll start with a couple of questions. I have a couple also on my mobile. Jignesh says, there are softer risks like emotional welfare. Is there any way to measure these?
I can take that, Asha. Can I?
Please do, Kirtana.
Okay, so in our organization, we have something called as a pulse survey. right? While we do our employee satisfaction survey on a quarterly basis with different sections of people, and over a period of year, we cover the entire population. We also have a pulse survey every time you log into the the company website. We are asked, how well are you feeling? It's basically to judge about your current state of mind, right? About how well you're engaged. What's your that moment's feeling, right? So these kind of surveys happen. It doesn't take more than 30 seconds or probably a minute to respond, and constantly these are used to monitor the level of I won't say satisfaction, because satisfaction is a much bigger thing, and that is assessed over a period of time. This is more about the immediate feeling of an employee, right? So the pulse surveys give you that. In addition to that, we are also having something called as Samaritans. So these are the people who are our business leaders, who are identified, who are trained to talk to people who are in need of counseling or some help. And identifying that again is with the managers. So constantly we work with the managers and ask them to engage with employees, connect with people very often. And if somebody feels something, they are referred to the HR, they are referred to these Samaritans who talk to them and counsel them and so on. There's a very important part of the employee wellness management.
Yeah, and do you use psychologists at times to bring in an outsider's perspective?
At times, yes, and we also work with our HR. They work with various doctors and psychologists from well-known hospitals, including Nimans and all, and they are involved in different studies, and some of those are also used, while coming up with different policies. We have something called as HAIL, which basically talks about the health and lifestyle of our employees. So there are a lot of suggestions that are given. During this time, more you communicate, the better. Lesser communication is a risk. So just communicate, right? So
right. There's another question. To what extent AI and data analytics has helped organizations in defining KRIs and evaluating the risk appetite? Ram?
I'll take it, Raj.
Okay, Raj, go ahead.
Yeah, I think the AI through the pandemic has come across as not the winner, if you like, in the sense that AI is constructed on past evolution of information and used to try and see how the future might look like. And of course, the pandemic has thrown a spanner into the whole future, and nobody saw it coming. So I think the process now is very much to learn and to revisit and to revise the process as we go through. So if you like, backtesting is very important. Forecast accuracy is very important. And when we look at backtesting, we're not looking at last year or anything. We're looking at how good was last period, perhaps last month, and what have we learned, and can we bring in any new ideas to go forward, and then keep continuous.
Yeah. Sorry to interrupt, Raj, but I think the question is: are they actually have organizations started using AI to estimate the probability of the risk?
Indeed. So then what's happening here is that once you've got the information, real-time information, providing some sort of validity and trust, then you're always matching that to your risk appetite. That are you getting the right data to make a decision point versus your risk appetite? So if your risk appetite is, for example, to make sure that you must have a certain headroom in your cash facilities, banking facilities, and the real-time information is giving you incorrect data, then you work very, very focusedly on getting the AI real-time data right, such that it's giving you what you require, and so I think that there is a pushback test process. It's a loop until you get to a place where you could trust the numbers. So the AI is in a constant state of evolution. That's what I'm saying.
Yeah, I think that helps in staying agile with our ERM framework.
Indeed. Indeed.
Ram, maybe you would want to take this question from the audience. While the board is concerned with strategic and business risks, the management is more focused on operational risk. How can a risk manager bridge the two? Example for the above is climate change risk, which is long-term, and management is more focused on short-term, high-probability risks like the white swans, and wants to keep aside longer-term risks since it would be a pressure on resource. I think this is a really valid question. You may want to take it, Ram. Sorry.
Well, I mean, it is a valid question. What I would say is, again, it all depends on the instances, right? So most importantly, the management is always focused on financial risks and operational risks, right? And all the other aspects of risks are always under the carpet, unless and until you brainstorm and you ensure the teams understand the nuances of each of their projects. But what I would say is, I mean, the exercises that we do normally, when I mentioned about the QRON, the QRS, which is the quantitative and the qualitative risk management services, these are the factors that actually come out, right? We talk about the probability, we talk about the impact, we talk about the owners of each of these risks. How are they going to mitigate it? I mean, risks could be internal, it could be external factors as well. So external factors, who is going to take responsibilities, right? You either accept it or you just go with the flow. So these are the areas that we kind of touch upon, and we also ensure these exercises typically, once the entire exercise is completed, we come out with a framework, we come out with a risk management framework for a particular project that is submitted to the senior management. And we also ensure that the senior management understands various project risks and not just focus on your margins, right? Which is what the management always looks at.
Asha, can I add a point?
Yeah, happy if you add on.
Yeah, thanks. So I would look at it in two ways. One, the way we have tackled this problem is, of course, we have the board level risk committee. And in fact, for a long time, our risk committee was called Risk and Strategy Committee because we wanted to bring focus on both risk and strategy. And in the management side, we have our risk councils, which are led by our chief operating officers. He chairs those meetings, and we have the business heads also, right? We have, this goes back to one of your earlier questions to Raj, if CFO is playing a key role, right? So CFO is part of the risk council, CFO, business leads, general counsel, chief risk officer. These are all part of the risk council, which is looking at various types of risks, right? And this is where the risk head or the chief risk officer bridges the gap between the risk board committee, which is looking at long-term risk, and the management, because it's for the risk officer to bring up even the strategic risk to the risk councils, right? So how do risk bubble up to the risk committee? You have layered governance. In our organization, you can see in our annual report also, we have a 9-layered governance for this, right? So starting from project to the segments or the service lines, and then it goes up to the overall delivery or overall sales risk, because these are all individual risk councils, where all the segment heads, all the service line heads, they're all part of it. From there, it bubbles up to the next level, which is called the operational risk council, strategic risk council, or legal and compliance risk council. These are the 3 councils which are chaired by our chief operating officer. It has a CFO, it has a general counsel, and it has a chief risk officer, right? So chief strategy and risk officer, plus all the business heads. So these are part of the 3 risk councils who look into various risks that bubble up in the organization. From here, the key risks are picked up and put up to the board risk committee. So there is a proper flow. We do not leave any of the strategic risk or operational risk. All the committees, like the strategic committee focuses on strategic risk, operational committee looks at operational, and legal and compliance committee looks at the legal and compliance risk. And any of these can bubble up to the board, because you can't say some compliance issue is not relevant, because that compliance issue may also have an impact on the strategic part. Like, for example, immigration regulation change in one of the key geographies that we operate, it may impact our ability to fulfill the needs of our customers, and that may impact our strategy, right? So there is a very close handshake between all these risks, and through a layered governance process, you can bridge the gap. And that is the role a chief risk officer can play, or a head of risk can play. And secondly, another aspect that can be done, which I've seen, is when the KPIs are being designed and assigned to the business leaders, if you are very short-term focused, right? Usually the KPIs are revenue, margin, and 2-3 things. But then you have to give equal weightage to the long-term KPI also, right? So 2 to 3 years hence, how will you develop a new service? How will you develop a new market, right? Those kind of KPIs also need to be plugged into the business leaders' KPI, and the KPIs that are being designed should be relevant to the business functions role, right? I think the KPI also plays an important role. This is where, if you bring risk and strategy together, then you will be able to play a role in helping the organization define those KPIs also. So that's how the gap can be bridged.
So very comprehensively covered. Excellent, Kirtana. I think the KP for every project, the KPI and the KRIs kind of have to align. Am I right?
Yes, absolutely. Because KRIs stems from KPIs.
Right.
When KPI is not being achieved, what is acceptable? When you call something a critical, a high, a medium, or a low, you start from the point the KPI is defined.
Yeah, I think this is a very practical point that I'm sure many would value. Thank you so much for that comprehensive coverage on that point. Would you like to add something, Raj?
Yeah, I think certainly KPIs can be a fairly solitary metric, and the thing that I've been focusing on recently is what I call, or what's known as, the critical success factor. So critical success factor is next layer up to the KPI. So that are the enablers, if you like, for the KPI. So, if you want to set up a number of stores and your target is, 10 KPI for argument's sake. Well, the critical success factor is saying, well, you need to have enough people, enough cash, etc., to enable that to happen. And so the CSF, if you like, is the most strategic aspect of measurement. And turning back to this bridging the gap on the operational side, just picking up on something that Katna said, what I find that CFOs are now taking the 3 layers of the strategy, the corporate, the business, and the operational, and they're taking the corporate vision statement and going to the heads of the business teams or the operations teams and saying, how do you interpret the vision statement and how will you measure success? And in doing that, you would naturally come across risks, and then the risks get escalated to the board level. So I think there's some very pragmatic methods out there to deal with this.
Interesting. Thank you, Raj. I think we have to sign off. We are running out of time. I'll take a minute to summarize the 3 takeaways that I thought I should share with the audience. But before that, quick comments from all 3 of you. Quick closing comments, starting with Kirtana.
Asha, I think it has been a good discussion. ERM is something, which is not a necessary evil. I would say organizations should look at it as a enabler to the process. if, it's like having brake in the car to drive fast, not like brake in the car, having a brake in the car to reduce the speed of the car, right? So organizations should look at ERM that way. If they can understand the benefits and if they can use ERM to their fullest advantage, they'll really, really surpass their strategic objective. Because ultimately, you need to manage your challenge and risk to your strategic objective, and then you meet your objective, right? So that's how you should look at ERM.
Yeah, it's a short-term pain for a long-term gain.
Yeah.
Great, thank you. Ram?
Well, firstly, Asha, a very well-planned session. Glad to be on this forum with all of you. But yes, the question is, most of them, the very first question, the basic question they ask is, where does risk management fit in, right? But I would say risk managers or risk management is, it fits in every other division of an organization, right? It could be your HR, it could be your mobility, it could be, your development, your sales, your pre-sales, everywhere. So I think, without a risk management team in an organization, that itself is a big failure on the organization front. So involving a risk team at every stage, definitely, makes a big difference. So as you rightly mentioned, short-term gain is, this is always fruitful for risk managers to be involved.
Yeah.
So thank you so much, Asha.
Yeah, pleasure, Ram. I think what you're trying to say is no organization is an exception to exposure to risks, and every organization should make sure that there is a framework in place in whatever bandwidth that the organization needs. So customized to the needs of every organization. Thank you. Raj, your closing comments, please.
Thank you, Asha. Well, look, it's been absolutely fascinating to hear the insights from the panel. It just goes to show that risk is here to stay. It's really about today and tomorrow. And I'm so delighted with the questions that we've had come in, really high quality. And it just shows that risk is now demanding a much higher place in the boardroom, and I think it really does require that. And what is a topical subject, I think you've helped elevate it to the next level. So thank you for that. Thank you.
Thank you very much for that. So from my end, I summarized 3 takeaways. Maybe I would have missed on some of them, but there are 3 that I felt was something that every organization should remember. In risk management, I think it demands a very cross-functional approach that can create a pull rather than a push culture in the organization. Point number 1. Point number 2, we are in an environment that's very dynamic, and every day internal environment changes, external environment changes exponentially. So agility is key to an effective risk management framework. And 3, tone at the top. I don't think anybody will debate that or disagree with that. I think the level of commitment to an ERM process starts from the top. It's up to them to demonstrate their commitment in supporting the hierarchy down the line and make sure that they create an ambience and an environment where they can open up and share freely on what kind of risks the organization is exposed to, so that preventive plans can be put in place, mitigation plans can be put in place, response plans can be put in place. So I think every organization can remember this as rule of 3. Thank you so much, Keertana, Ram, and Raj. And thank you all, also in the audience, for sparing your valuable time on Sunday to participate and make this event very engaging. Thank you very much.
Thank you. Thank you, Ash.
Thank you all.